Let's begin with a story that might sound familiar to many. It's a tale of ambition, a little bit of overconfidence, and the hidden rules of the game. A story about how the allure of quick riches can sometimes lead down a path paved with unexpected obstacles. Meet Dave. Dave is your average guy, steady job, decent car, a mortgage to pay, and dreams of something more. He's not necessarily looking to get rich quick, but he wouldn't mind a little extra financial freedom. He's worked hard his whole life, played by the rules, and now he's wondering if there's a way to make his money work harder for him. And a burning belief he can outsmart Wall Street from his couch. He's been reading articles, listening to podcasts, and he's convinced that with a little bit of research and a smart strategy, he can beat the system. He downloads a trading app, deposits a few $1,000s, money he's carefully saved, thinking of it as his initial investment in his future, and feels the rush. The adrenaline of making a trade, the potential for profit, it's intoxicating. He's watched the YouTube gurus, read the Reddit threads, he's ready to trade. He's absorbed all the information he can, or at least he thinks he has. He feels prepared, armed with knowledge, ready to take on the market. Dave buys a hot tech stock, sells for a small profit, a quick win that reinforces his belief in his own abilities, and feels like a genius. He's cracked the code, he thinks. This is easier than he imagined. He repeats the process, convinced he's on his way to riches. Each successful trade fuels his confidence, making him bolder, more willing to take risks. But every tap he makes is being tracked, not just by him as a record of his trades, but by the platform itself. Every click, every trade, every search is being analyzed. The app isn't just a window to the market, it's a one-way mirror. Dave can see the market, but the market can see everything about Dave. The brokerage knows his balance, how much he has to play with, his risk tolerance, and crucially, his day trade count. They know exactly how many trades he's made in the last few days. Enter the Pattern Day Trader Rule, or PDT, a regulation designed ostensibly to protect inexperienced traders. If you have under $25,000, you get only 3-day trades in 5 days. A day trade is defined as buying and selling the same stock within the same trading day. Make a fourth, and you're locked out for 90 days. Your account is restricted, you can't buy or sell, you're essentially sidelined. Dave, with $4,000, is on a clock he doesn't even see. He's completely unaware of this limitation. He makes his first trade Monday, feeling confident and in control. Another Tuesday, the wins are adding up, he's feeling good, a third Wednesday. He's used up all his day trades for the week without even realizing it. Suddenly a notification, you have 0 day trades remaining. A message he doesn't understand, a rule he didn't know existed. Now he can't sell a new stock the same day. He's stuck. He's holding a stock that's plummeting and he can't do anything about it. He's become predictable, vulnerable, a perfect target. His lack of knowledge has made him an easy mark. The PDT rule claims to protect small investors from themselves, preventing them from overtrading and taking on too much risk. In reality, it's more like handcuffs than a helmet. It restricts their freedom and limits their ability to react to market changes. It creates a class of traders, retail investors, trapped by rules, unable to react quickly. They're at a disadvantage compared to larger institutional investors who aren't subject to the same restrictions. Dave thinks he's just dealing with a quirky rule, an inconvenience that he'll have to work around. He doesn't realize he's just painted a giant bullseye on his back. He's signaled to the market that he's an inexperienced trader with limited resources. The industry knows exactly when he's stuck and how to exploit it. They can see his positions, his limitations, and they can use that information to their advantage. The game isn't about beating the market, it's about surviving the trap set for people like Dave. It's about understanding the rules, the limitations, and the hidden agendas. The PDT rule isn't just a speed bump, it's a setup. It's a hurdle designed to trip up inexperienced traders and make them more vulnerable. Dave's not just playing the game, he's become the game. He's a pawn in a much larger system, a system that's designed to benefit the few at the expense of the many. And he's not alone. There are millions of Daves out there, all trying to navigate the complex world of Wall Street. Welcome to the real Wall Street, where the rules are often hidden, and the game is rigged. Your brokerage account isn't a private vault, it's a surveillance hub. The platform tracks your every move, account value, cash, buying power, margin use. Algorithms monitor your open positions, watch list, and yes, your PDT trades. This isn't just for your benefit, it's a product. Your data is aggregated with millions of others, creating a live map of retail sentiment. The brokerage knows when you're confident, when you're sweating, and when you're trapped. This data is packaged and sold to those who know how to use it. While you're analyzing charts, the brokerage is analyzing you. They know your limits better than you do. Your hopes and fears are just data points. The real product isn't the app, it's you, and your every move is for sale. So what happens to all this data that's generated every time you use your phone, browse the internet, or make a trade? Where does it go and who has access to it? It doesn't just sit on a server gathering dust. It's far too valuable for that. It's bundled together with other data points, anonymized, though the effectiveness of that anonymization is often questionable, and then sold to the highest bidder in a complex and opaque marketplace. This is the real business model that underpins much of the seemingly free services we use online, payment for order flow, or PFOF, a practice that's become increasingly prevalent in the world of online trading. When you place a trade through your brokerage app, it doesn't go directly to the exchange. Instead, it's routed to a market maker, not straight to the exchange, bypassing the traditional order routing process. These firms pay your broker, often fractions of a penny per share, for the right to execute your trade, a seemingly small kickback that adds up significantly. Because seeing your order flow before anyone else is a huge edge in the fast-paced world of trading. They can front-run your trade using sophisticated algorithms to anticipate your moves, making fractions of a cent on each transaction, that, when multiplied across millions of trades, add up to billions of dollars in profit. But the real gold, the truly valuable asset, is the aggregated data that's gleaned from all these individual trades. Hedge funds and other institutional investors subscribe to these data feeds, showing them in near real time what retail traders are buying and selling. While it's technically not insider trading, as it's based on aggregated data, it provides a significant competitive advantage, offering insights that are the next best thing to having inside information. The brokers get paid for routing your orders, the market makers get the edge by seeing your orders first, and you get the illusion of a free trade, masking the true cost. You might think you're a lone wolf, making independent decisions, but in reality, you're just broadcasting your every move to a pack of wolves who are ready to capitalize on it. The system is cleverly designed to extract value from the uninformed, and unfortunately, it works with remarkable efficiency. Once retail data hits Wall Street, it becomes a signal. Quants and pros don't see individuals. They see patterns and herds. Their algorithms predict what retail will do next, and what they'll be forced to do. They exploit predictable behaviors, chasing hype, panic selling, margin calls. If they see a surge of retail buys, they see opportunity to trigger a sell-off. They engineer outcomes, not just react. Trading becomes psychological warfare. The pros trade the players, not the stocks. And they've already written the ending. Let's talk about the PDT exhaustion trap. Dave uses up his 3-day trades. On Thursday, he sees a hyped stock and buys in, thinking he'll sell tomorrow. He's locked in, can't sell until the next day. Pros see this en masse. Their data shows thousands of Daves trapped. They let the stock run. Then, in thin after-hours trading, they short sell aggressively. The price plummets. Dave and others watch helplessly as profits vanish. By market open, the stock has crashed. Panic selling begins, pushing the price even lower. Pros cover their shorts at the bottom, pocketing the profits. They didn't just predict the panic, they manufactured it. The PDT rule, meant to protect, becomes a weapon. It's a legal, system-abiding mugging. Dave never stood a chance, and this playbook runs every week. Margin call. Mining is the slow-motion version of the trap. When you trade on margin, you borrow from your broker, amplifying gains and losses. If your stocks drop too far, you get a margin call, deposit more cash, or sell. Pros know exactly where these tripwires are. Their data shows clusters of retail margin accounts at specific price levels. They target those levels, short selling and spreading fear to trigger forced selling. Once the price drops, margin calls go out, retail is forced to sell, and the price crashes further. Pros buy at the bottom, closing their shorts for huge profits. They didn't get lucky. They engineered the drop. Retail's weakness is their opportunity. In the intricate dance of the financial markets, a fundamental question arises: who are the buyers of your data? Who are the entities eager to get their hands on the information generated by your trading activities? They're not hiding in the shadows. These are established players, prominent firms operating in plain sight. Consider Citadel Securities, a powerhouse in the world of market making, and Virtue Financial, another key player known for its high-frequency trading prowess. These firms are the biggest market makers, the entities that provide liquidity and facilitate trading across various asset classes. They're handling a huge share of retail trades, acting as intermediaries for a significant portion of individual investors' transactions. To gain access to this valuable order flow, they pay hundreds of millions of dollars. These payments go to brokers, compensating them for the privilege of executing your orders and accessing the data associated with them. Then there are the hedge funds, sophisticated investment firms like Renaissance Technologies, renowned for its quantitative approach, and 2 Sigma, another prominent player leveraging data science and mathematical models in their investment strategies. These firms subscribe to aggregated retail data, seeking to glean insights from the collective behavior of individual investors. To analyze this data, these firms employ armies of PhDs and harness the power of supercomputers. Their goal? To identify and capitalize on emerging retail trends, often before they become widely recognized. In essence, they aim to front-run retail trends. Even firms perceived as friendly to retail investors like ARK Invest, led by Cathie Wood, closely monitor retail sentiment, recognizing its potential impact on market dynamics. The ecosystem is vast and interconnected, a complex web of relationships and data flows. Brokers sell the flow of your orders, market makers scalp it for tiny profits on each trade, data vendors package it into valuable market intelligence, and hedge funds profit from the insights derived from this data. In this intricate system, retail traders are essentially the raw material, the source of the data that fuels the entire machine. Wall Street, with its sophisticated infrastructure and analytical capabilities, turns this raw material into substantial profit. They're not just in a different league in terms of resources and expertise. They're playing a fundamentally different sport, with different rules and objectives. And to further enhance their advantage, they're constantly reading your playbook, analyzing your trading patterns and strategies. They're doing this in real time, gaining immediate insights into your market behavior. The game is rigged in their favor, giving them a significant edge over the average retail investor. Yet, surprisingly, it's all out in the open, with much of this information readily available for those who know where to look. In this complex landscape, you're not just a participant in the market. You're the product, the valuable source of data that fuels the Wall Street machine. This isn't a conspiracy, it's the business model. Robinhood and others openly disclose payment for order flow in SEC filings. Regulators know all about it, fines have been issued, but the system remains. Lawsuits during the GameStop saga revealed the deep ties between brokers and market makers. When retail frenzy hits, brokers call their HFT partners first, not their customers. It's legal, documented, and regulated. The industry monetizes the predictable behavior of its least experienced users. Democratizing finance is just a marketing spin. The house always wins because it sees your cards before you play. Here's the truth. As a retail trader, you're not just playing the game. You are the game. Your trades, your FOMO, your panic, they're the signals pros use to profit. Every free trade feeds the machine, refining Wall Street's strategies. The system is designed to extract your capital, not help you win. Some get lucky, a few are skillful, but most are outmatched. You're bringing a knife to a drone fight. The promise was democratized finance. The reality is easier prey for Wall Street. The real secret isn't a fancy algorithm, it's predicting what the least informed will do. And now, they have a perfect, real-time window into your mind. Next time you open that app, remember you're not the hunter, you're the signal. The game was never fair, but now, you know the rules.